Okay, it's 3:35, so why don't we get started? Let's
Okay,
see. Floor's yours, Jason.
okay. Hi everyone, welcome back to Student Investor Society. Today we'll be doing seminar two. I'm Jason and presenting with me is Jeffrey, and we'll be talking about stock options.
Yes, so to understand what stock options are, we have to first explain what exactly are options. Options are like a contract. It gives the investor the right to buy or sell a stock at an agreed upon price and date. And there are two types of options: puts, which is a bet that the stock prices will drop, and calls, which is a bet that the stock prices will rise. Next. So, why trade options? There are two main reasons why investors trade options. One is speculation. So, when investors speculate that there will be a future price change, they trade options to make a profit. The second reason is for trading options is because it allows investors to reduce the risk for their portfolio overall. So an example of hedging is when, let's say, someone has a lot of money invested in one stock. They might buy a small portion of put options to balance out the risk, because if the stock does drop, they still make some money from the put option, which kind of balances things out. Next.
Yeah, so as Jeffrey mentioned before, options aren't actually the stock themselves, but it's a contract that grants you the right to purchase or sell stocks at a specific time. And yeah, it's just not the stock itself. And so stocks are also derivatives, which mean that the price of the option or um, factors of the option derives from the stock price itself. So that a change in the stock price can mean a change of price in the options as well. And when you buy options, it's typically represents 100 shares of the related stock, and it's also purchased through a brokerage account, which people also use for purchasing or trading stocks. And the price for options is called a premium. Next. So expanding on the premium or the cost, essentially the premium is the cost of the options you purchase. So the premium is determined by taking the price of the call or put and multiplying by the number of contracts bought, then multiplying by 100, since you're buying 100 shares or you're buying the right to purchase 100 shares. So for example, if I were to buy five options at $3, it would be $3 times 100 times 5, which would make my purchase $1,500. And so the premium also depends on the cost of the stock price, as mentioned before, but is different from the cost of the stock. And for example, the price of the option could be $3 per share, but the stock itself is worth $68. And so since it's also different from the cost of the stock, the change in the price of the options could also be very different from the change in the price of the stock as well. And so when you make money from using your rights from the options to sell or buy stocks, the profit you made from selling or buying the stocks would also need to pay for the premium to overall make you money or be profitable. So for example, say you purchase a call option at 50 cents to buy a stock at $1 per share next month. So you're set to pay $100 with $50 spent on purchasing the option. So overall, you're set to pay about $150. And so when next month arrives, the stock is at $2 per share, which is a 100% increase from last month. And so you purchase the 100 shares from your option for $100, even though they are worth $200, since you had a contract saying you could purchase those shares for $100. And then so you gain $100 from the stocks you sold, but then you still pay $50 for the option since you bought the contract. So overall, you gain $50. Are there any questions on this? Okay, next.
Okay, so now we're going to talk about calls versus puts. So calls is when you're betting that the stock prices will rise. It gives you the right to buy a stock at an agreed upon price. Puts work similarly, but it's the opposite. Puts is when you're betting that the stock will drop, and it gives you the right to sell a stock at an agreed upon price. So an example for calls is, let's say you bet the stock will rise. The agreed upon price is $100. And if the stock price goes to 200, you still have the right to buy the stock at $100, even though it's now worth 200. Puts work in the same way, but just kind of opposite. So let's say the agreed upon price is also just $100 and the stock drops to $50. You can still sell the stocks you own at 100, even though it's now actually worth only 50. Next. So time decay. Time is a major factor when it comes to determining the value of the option. As the expiration date of the option draws closer, the value of the contract becomes less. The option you purchase will constantly lose value until it reaches zero and expires. Time decay is not linear and will accelerate, as you can see from the graph. Therefore, options tend to lose more value in the final 30 days before expiration. The reason for this is because the less time you have before expiration, the less likely it is for the stock prices to change and the less likely it is for you to make a profit. Next. So strike price. The strike price is the price at which a put or call can be exercised. It is the predetermined price that both parties agreed on. And there are two terms, in the money and out of the money. In the money is when your contract expires and it has value. Out of the money is when your contract expires and there is no value left. So for calls, in the money happens when the stock prices go above the strike price. Puts in the money happens when the stock prices drop below the strike price. So an example, Bob, let's say, bought a AMD calls at the strike price of $100. The stock prices went up to 150 and it is now in the money. He then can choose to exercise his right to buy the stock at 100, even though the actual price is at 150. But let's say Bob, again, bought AMD calls at the same strike price of 100, but instead of rising to 150, the stock drops to $50. Then it's not in the money, and there's no reason for him to exercise the contract, because why would he buy a $50 stock at $100? It just doesn't make sense, and it has no value. So he would just let it expire. Next.
Okay, so as Jeff said before, a lot of investors tend to trade options because of speculation or hedging. And while it might sound like a really safe option compared to just trading stocks themselves, there's also some risks involved. So the main two are volatility and time. So as said in the time decay section, options have an expiry date, contrary to stocks, whereas they don't. So that means you could potentially lose all your money you paid for the option if the option is out of money at the expiry date. So basically, if the stocks or the shares the price isn't going the way you want, then that means you could potentially lose all your money the closer it goes to the expiry date. So for example, if you have a call option with $10 stock price and the stock is only at $6, you would not exercise it as said before, because you wouldn't gain any money from that. So then when the expiry date comes, you just lose all your value of the option premium. And yeah. And the other risk would be volatility. So options are significantly riskier as they have a higher volatility, which means that there are larger price changes to the option throughout a time period. Like I said before, the change of prices in options are very different from the change of prices in stocks. So for example, if a stock goes up or down 1%, the options from that stock might go up or down a lot more, such as 10%. And this is because since the stock changed by 1%, people might think that it might go higher or lower based on that change. Next.
Oh, can I add something before we go to the next slide? Yeah, so like Jason said, it's a lot riskier trading options instead of stocks. So it's actually not recommended for beginners to start trading options. And it's better to trade in stocks or at least use a simulation and get some practice before you start doing this. And you're also trading because each contract represents 100 shares. So a lot of times you're actually investing quite a lot of money. So you have to be really careful when trading or dealing with options in general. Yeah, next.
So now we have some reflection questions. Next. Yeah, so everything we went over this presentation should be able to provide you with the information to answer these questions. It would be great if each person could pick 2 or 1 or more if you'd like, and just put your answers in the chat. We'll give you some time to answer these.
Hi, Sunny. Your question about should we trade USD or CAD in Canada? So definitely, if you're trading in the Canadian market, of course, then you would choose in Canadian dollars. But if you are trading in the US market, you do have to convert your money to USD first. But then some brokers will require you to convert back and forth from CAD to USD if you're buying, and automatically convert it back from USD to CAD if when you sell it. So it really depends on your broker. Some will let you keep the money you sell in USD. Some will force you to convert it, but then the conversion has a fee. So then, yeah, it's usually a better deal to not convert it every single time.
Can I add something to that? Sunny, so if you want to trade in the US markets, it's better to start or create rather a new US brokerage account. So then you can directly put US dollars into it instead of converting Canadian dollars to US dollars every time, because the rates they give you in like TD or BMO are ridiculous for CAD to US dollars.
Yeah, I typically use Questrade. So in Questrade, you only have to convert your money once into USD. Like the fee there's a small fee, there's like 2%, I think. But then, yeah, but then I buy and sell in US dollars, so I don't have to convert it back to Canadian dollars every time. I use Questrade. And Josh Wu, will AMD break 100 this week? I hope it does, but I don't know if it will.
Sunny asked, what did you guys buy? So right now, I'm actually investing in an ETF called, what's the name again? It's ARKW. It's basically exchange traded fund, which is managed by like a fund manager. And then it's basically a diversified portfolio where they invest into many different assets like Tesla, Bitcoin, and many more. Yeah.
Yeah, but remember, what we invest in doesn't mean it's right. I always lose money in the market.
That's true. You shouldn't invest based on what other people tell you. You should think for yourself. Acknowledge the risks and determine if you should invest or not. Sean asked, "Are we gonna learn how to trade cryptocurrencies?" That actually, I think that could be our next seminar's topic. Yeah. Sunny asked, "What tools do you guys use for stock news?" Personally, I use Yahoo Finance,
Use
or I
Google.
just fair enough, or I use the stock app on iPhone. Yahoo News is kind of bad. It gets better when you're used to it. Andy asked, "What is your opinion on cryptocurrency?" Uh, my opinion on cryptocurrency, honestly, how should I say this? It's very high risk, high reward.
It's very volatile. That's what I'll say. You can either lose a bunch or you can win a bunch. So that actually depends on your own risk management as well. Yes. So thank you everyone for your questions. What do you think about BlackBerry? It's gone up a lot. I don't know much about it. Some stocks are very crazy. We've seen GameStop go up almost 100 times this year from $2 to 220.
If we look at GameStop right here, today it just went up 92%, and after markets it's up 53%.
So this can really show how the markets are really volatile. Like it can go up a lot, but you see stocks that are going down 90% per day as well. So it's very crazy. And Sunny, should we trade with the TFSA account? TFSA, yeah, if you have the limit, then use it because you don't have to pay taxes on any money you make. But then if you lose money in the TFSA account, you can't deduct it. You can't deduct it onto your income if you lose it. So then there's pros and cons in there. Okay, so yeah, Sunny, so then you can move around TFSA. It's like once you put it into the accounts, you can take it out, but then there's a limit, there's a contribution limit. So once you take it out that year, you have to wait until the year after they'll give back the amount you took out back to the limit. So you can put it back in. So there's more restrictions in moving the money. No, Andrew, it's not tax evasion. Tax evasion is illegal. Andrew, taxes are not a suggestion. Taxes are the law. We all follow the law here.
Sunny asked, "When are we learning about reading graphs?" That will be a future topic.
So thank you so much, everyone. And pretty much, I think that's it.
Any last